All right. But
I agree with this. I think that your money for now is safe in a bank. There is FDIC insurance. They did break the buck on some money market funds, but that got kind of fixed. That meant that if you bought a money market fund, you might have 98 cents versus $1. I mean that happened. But we are in unprecedented times, right?
Truly.
I think you're understating the systemic risk that everybody has been just totally freaking out about. The amount of the trillions of dollars that our government and central banks are dumping all around the world to support the banking system, to keep it from collapsing, isn't happening because all of these banks are well capitalized. There were some serious problems here, and it's likely that we're getting through it, but there's a lot of unknowns.
When Don says there's a difference here, you take care of commercial banks. You're talking about real live banks that have a federal FDIC insurance. You have to do all the regulation, compared to Citigroup or other groups that can do all sorts of other things. Yeah, you can keep your money there, but they're doing brokerage, they're selling products, they're doing other things. You know, I keep hearing right now that you guys aren't lending. And I hear this constantly. Banks aren't lending. We're giving them all this money. We're putting our kids into debt. We're making you flush with cash, and you're just hoarding it, you greedy little bastards. But when you look at the difference between these investment houses, brokerages, and then what is legitimately
simple
banks.
Explanation.
Nationally,
what's the truth? Banks are lending the same amount in 08 that they did in 07. It was down 0.4%, but effectively flat. Here in Colorado, we've done a remarkable job of actually increasing lending year-end 08 to year-end 07 by almost 12%. And given the pressures that would tend to push down lending, that's pretty remarkable. So lending is up, but why the public perceives that you don't have credit availability is that the non-bank sector, all these other financial entities out there other than banks, are twice the size of banking. It used to be that banks had 70% of the credit market. In recent years, we've only had 30%, and this non-bank sector made up 70%. We're continuing to lend the same amount, but that sector that's twice our size has crashed to some small fraction of what it was lending 12 months ago.
This is really important, because when people are screaming at banks, and I hear it all the time, the banks aren't lending. The fact
They're
is,
talking about this non-bank sector.
Banks are lending as much as they've ever been,
or more.
But we're talking about what you're saying people consider to be banks, all these other pseudo banks, which are brokerage houses, hedge funds, and
well,
all
there's
these
plenty
groups
of credit card issuers, mortgage brokers. There's plenty of lending out there that wasn't part of the banking system. That's all gone. That was really easy money.
And it does impact Main Street.
They were making loans to anybody with a pulse. Okay, that is all gone. The community banks that Don represents cannot fill this enormous void, nor should they. One of the reasons why credit is tighter is because our credit isn't all that good. I mean, look at all these people that went into foreclosure and went into bankruptcy, and now they want to start a new business, right? And it's like, well, you know, what's your record? You can't make loans to people the way we just did. That was why the whole thing blew up to begin with. Credit was too loose. We've tightened credit. So yeah, there's a perception that there isn't as much lending available, and there
fair
isn't.
To say
but
that
you can't loan to people that don't have good credit.
Right. So would it be fair to say that when people are angry that banks aren't lending money, that's a misnomer? It's that banks are loaning just like they always have, but all these other organizations that we've grown used to getting money from.
Yeah, I agree with that.
Right.
And I think you've got another thing going on. Despite the fact we're in the business of making money by providing credit, this country is addicted to credit. We have abused it for so many decades at the consumer level.
Fortunately, we've got a president now who doesn't want any more debt. So
at the business level and at the governmental level. All three sectors have just abused credit. They're addicted to it like it's a drug, and it's painful to get off of that. But that's effectively what's happening. Banks have continued their fairly high credit standards. We've always been the conservative lenders that people make fun of.
Well, and that's because it's hard
to get a loan only when you don't need it.
Right. It's hard to get money from a bank. It was easier to get money from all these other.
Well,
that's why they grew so fast.
In the mail. Here's a check.
Credit card.
Take this check to the bank, and you've automatically applied for this loan, right? You used to get that.
That's why they grew so much. But in fact, they've learned that that doesn't work, and they're reverting effectively to the bank model of lending, which is actually make sure that the asset is worth more than the loan, that the borrower has a reliable source of income with which they can repay that loan over time, not just for the next 6 months, but over the life of the loan. And you start doing those things that drive our customers crazy. You know, you want to see the last 3 years' income tax returns, you want to see a recent appraisal on that property, all that paperwork that annoys John Caldera.
It sure does. I just went through it.
Yeah, but those things are what actually keep keep the banks safe and solid, and the rest of the credit granting world, these non-banks, is moving back to that model because they know it works. And so as a result, they've tightened up on credit standards, and they're not lending.
They've had to.
They had to.
They absolutely have to.
And, you know, I will acknowledge that there were some banks that were probably too loose in their lending, but generally not. The industry generally has been very conservative, but you had a lot of stupid lenders, to be honest about it, out there granting credit to people who had no means of paying it
But
back.
it's also the securitization of these bad loans.
Agreed.
And that, you know, you take a mortgage, right, and you stick it in a whole pool of mortgages, and then you create a security that draws on the revenue stream of those mortgages being paid. And that's, you know, a mortgage-backed security, right? Well, all of our banks, I'm not sure about community banks, the banks that Don's representing probably didn't get into this game, but the Wall Street banks, the money center banks, they all have these deep portfolios of these mortgage-backed securities. Well, now we're in a recession, okay? First,
so the mortgage or the properties are worth a lot less than they were a couple years ago.
Right now, but they will rebound.
Well, as property levels decline, these essentially become unsecured loans. And so the big banks of the world are stuck with all of these unsecured loans. That's their problem. All right, the banks that you represent have a different problem, and that is that the economy is in a recession. There's some talk that maybe we're going to come out of it this year, but there's a lot of activity that affects banks. You know, a lot of your customers are, for instance, in the construction business. A lot of your customers are small business owners. As these businesses fail, that's going to affect community banks, and that's why there's some analysts who think that, yeah, okay, we've only had, and by the way, I hate to say the word, only 30 banks failing is a fairly high number. It's not
Depends on your yardstick, though. Compared to the last few years, yes.
Yes,
compared to the last stressful time, no.
Compared to the savings and loan crisis, we're not there yet.
Stop there for just 2 seconds. During the Great Depression, and you remember that, we had something like 3,000 to 5,000 banks a year going under. We have a lot fewer going under now, but is it fair to say that our banks today are huge? The banks back then were tiny little mom and pop, so more than we're going to go under.
We've still got small banks now, as we did back then. To bring this down to Colorado level, we went into the Depression with 600 banks in the state. Every little wide spot in the road had one. We came out of it with 200. 2/3 of the industry just went away. Now, I don't know much more history about that era than that.
How about the savings and loan crisis, though? We lost a lot of banks or savings and loans back then.
And the ones that remain generally were purchased by banks, and so they're now part of the banking industry.
Right.
But between like 1992 and last year, no banks failed in Colorado except for one, who was run by Ed Matar, who you know ended up being a Ponzi schemer. Sorry to use that word again, but he really was, and he was convicted. But
that's true. That one I won't argue with.
So really, 2 banks failing in Colorado is a lot, and I think there could be more, based on what I'm hearing from analysts who look at banks.
What are you hearing? Give me. We've got about 10 minutes left. Let's start putting on the crystal balls.
I'm just hearing that the thing that's slowing down the economy right now, the recession, look, unemployment is climbing, more and more businesses are failing, personal bankruptcies are rising. There's a lot of things that are going on in the economy that's actually slowing the economy. This is going to affect banks. Banks that have huge lending portfolios in you know, small business areas or even in real estate are going to be under stress. Some people, I'm not saying I agree with this, but I have read reports from people who analyze banks that say 1,000 to 1,500 banks are going to fail.
And when you say banks, are you using Don's definition of banks?
Yes, I'm using Don's definition of banks. The big banks have already failed. They're gone. If it wasn't for the fact that the federal government is bailing them out to the tune of billions and billions of dollars, they'd be gone. There would be no Citigroup or Bank of America.
Would that
they'd be gone.